We can relitigate what you think he was actually really trying to say or whether he should have said it. But I think the bigger question right now is you saw the numbers that Steve had in terms of what the expectation is for the rest of the year. And that's what's going to, I think, going to move markets one way or the other. So
right. You're
to my right. I'll go to you.
Sure. So we're looking for another 2 more cuts this year and another 3 cuts next year. So I think...
let me ask you a different question, though. Where were you 24 hours ago?
We haven't changed our call.
Okay.
So the idea is, I think what the market was very disappointed with was there was no clear reaction function. And I think Steve's absolutely right. I think the committee is pretty divided here. Some want to do 1 or 2 cuts. Others are kind of nervous about does global growth slow down, feed through into the U.S. And I think that division in that committee was somewhat clear. So
I'm not sure Williamson, don't forget, wanted to do at least 2 and go very aggressively.
Exactly, right. So you've got people, across the spectrum. I think it was not so much a miscommunication as they just don't know. And I think it's very hard for the market when the central banker says, we actually don't know, we'll figure it out.
Were you surprised by the reaction of the market since this was the expectation? Or was this a sort of buy on the rumor, sell on the news?
I'm more in the latter camp. I think we went in with a lot of expectations. We wanted the Fed to clarify that they're going to continue to cut, and they didn't really do that. I think the Fed...
But was that just a mistake? Should he just shut up? I mean, is that part of this was just... No, honestly.
Right. Or to say that mid-cycle adjustment could be more than 1 cut. I think the market's pricing in 4, maybe that is a mid-cycle adjustment. It's not just 1 cut. But I think what the Fed is trying to do is sell this very hard as an insurance cut. I think the bond market is not convinced that that essentially insurance cuts will work. It's not sure. Rates are already pretty low. So does housing get a boost? Does CapEx pick up? I'm not sure CapEx is low because of high rates. So I think that's where the market sort of reacted with this disappointment that insurance cuts don't work. The Fed has to cut a lot more.
Eric, does Jay Powell realize that the market can ultimately put him in a box? Does he get that?
Well, I think he realizes that there's this third issue. He has his 2 mandates, but the third issue of solving the rest of the world's problems is really the challenge here. Very little has changed. Almost nothing changed in the official statement. The only thing that changed was some reference to the global economic situation, which isn't necessarily anything the Fed should be worrying about unless there are knock-on effects into the U.S. We have a little different view. We were 1 fewer rate cut than what the market was pricing in. Market was pricing in 3 to 4 over the next year, 2 to 3 this year. We were always 1 under that.
You were always 1 under that, even prior to yesterday.
Correct. And we think part of what happened yesterday, well, you could look at the market movement and you could say Powell just muddled the communication. I think there's an element of that, just looking at when the market sold off.
Okay, so if you were Jay Powell, what would have you said? What could have you said that would have sort of threaded this needle?
Without coddling the market.
Well, I think he could have been very clear that this was going to be a multi-cut that it was mid-cycle, it was insurance cut and adjustment, that it was going to be multi-cuts. He, to a certain extent, what happened in the market was just taking out the 50, that tail upside expectation around a 50 basis point cut. You could say that, we're now up 20% on the year instead of 21% on the year. P multiples are from 14.8 to 17. 1% haircut is not that big a deal.
Did you just call it a tantrum, or was it? Is this a tantrum, or is this a bigger issue? Meaning, because there was a little bit of a heart drop moment. I don't know. I sort of had it with Joe.
I think it's crazy. I think you're going to keep going back on.
Jay Powell, he says exactly what he's thinking, and it makes total sense. And that's what you can't do as the Fed chairman.
You got to a little bit on the whole recession policy.
A mid-cycle, with 9 total quarter points left, how can it be anything other than an adjustment? And that's all he's really saying. Maybe we got a little bit too high. Maybe the December thing was wrong. We'll take this back. Then we'll take a step back and see what happens.
And we'll see what the data says.
I've called these traders. And you know what? We're only talking about, at the worst levels, it was, what, 2%?
2% for the NASDAQ. The S&P and the Dow were only down by 1.8%.
And we know they're spoiled brats.
And to your point, Eric, we're still up 20% a year.
The biggest concern...
With earnings basically flat, as Bob Pisani.
And that's really it. It's about stopping focusing on the Fed. That was largely priced in, and getting back to focusing on the real economy and what's going to drive earnings and what's going to drive economic growth from here. The biggest concern that we would highlight out of yesterday's move was the response of the dollar. The Fed hasn't cut for 10 years.
Dollar index was up 0.6%.
And against the euro was up even more. And our expectation is that the dollar will start to soften later this year as interest rates converge and economic growth converges. If you get a situation where the dollar is rallying from here, that puts stress on the entire financial system and does create the potential for some kind of competitive monetary policy.
What can you do? I mean, is this a constant? I'd say a race to the bottom, but we've already blown through zero in a lot of different countries.
In other markets, that's an area of concern. It's not our base case. We do think dollar's overvalued, that it should be softening from here, at least not rallying strongly. If it does, that would cause us to be much more cautious.
I would completely agree with that. I think the fact that the Fed, and I think it's remarkable, for the first time, they've actually explicitly linked their Fed rate cuts to global developments. You know, he was very clear. Now, if the focus of the Fed to cut rates is that you want global growth to pick up, but in the process you're getting a stronger dollar, well, that's going to weaken EM. That's not going to help business capex. Yeah. You know, and I think, you know, one of the things that the market didn't like was when he was asked about recession, he sort of fumbled a little bit. You know, I think the market wants the Fed to say, if we see a slowdown, we're going all in. Right. And we didn't get that strong reaction function aspect from the Fed. So if the data does turn out a little bit weaker, we're actually very concerned. I'm not sure that the U.S. can continue to grow as this one beacon of strength when the rest of the world is slowing. You know, you look at Europe, you look at EM, it's all slowing. I'm kind of concerned that this business investment weakness is finally going to show up in hiring. Okay. So I think data is going to be absolutely critical.